Your banks have this special investment product that gives you 6 to 12% per year of guaranteed interest. Now, if you do not know it exists, the possible reason is that you are not a privileged or priority or private banking customer. In other words, don't have enough money in your bank account for your relationship managers to offer it to you. Or if you have invested into it, or if you do have enough money in your bank account but you have never heard of it, then I don't think you fully understand how it works. But I'm going to explain everything, no holds barred, in layman here, so make sure you don't skip a second. Now, it is a structured investment product known as Auto Callables. Now, this can be based on, usually a single stock or a stock market index or even a currency pairs like US dollar versus Malaysian ringgit or other currency. Now, typically, these Auto Callables have a maturity period of say 12 months and offer a guaranteed interest payout ranging from 6% per year up to 12% per year. This sounds very tempting, and many investors actually jump into it without really understanding the other side of the equation, which is the risk, right? Even the top 15 income bracket of Malaysians, which I usually advise on, and I realize that they don't fully understand how these complex products work. So say your bank offers you an auto-callable structured investment product with a 10% annual interest guarantee, right? And it's based on, say, for example, Alibaba stock with a 12 months maturity. If the stock price of Alibaba rises above 5%, above the strike price, just assume $10 a share, this is actually known as the knockout price. Or if it rises 5% or even more within a few months, then this product ends, it auto terminates, and you get your money back with interest. Or it ends anyway, it terminates anyway after 12 months, right, when it so-called matures. But if the stock price drops below a predefined so-called knock-in price, say 20% below the strike price, you might end up with less than what you have invested. Now, let me explain. I give you a scenario. Say after 4 months, you invested a certain amount, say 100,000 or whatnot, and the share price of Alibaba actually breaches $10.50 per share, and the knockout price is being triggered. You get the accumulated or outstanding interest owed to you, and also you get back your initial principal of say 100,000. Now, in the second scenario, say the share price of Alibaba drops no lower than $8, right? And in fact, so it doesn't hit that knock-in price, right? In fact, just assume that, for the entire 4 months, the next 4 months, or up to 12 months, it's just a range bounding between $8.50 to $9 per share, right? What I call is between what they call as two adjacent observation dates. And what happened is that you continue to receive the 0.83% monthly interest up to 12 months. So everything sounds fine until I give you scenario number 3. Now, Alibaba stock price says, it falls lower than $8 a share, say at $7 a share. The knock-in price is being triggered, and you, the investor, get back all Alibaba shares or stocks that was bought at, say, at $10 a share, plus any, prorated, accumulated, or whatever interest that is due owed to you. Now, you bear in mind, Alibaba stocks has declined like 30% from $10 a share to, say, $7 a share. And the thing is, you do not get back your initial 100,000 invested in cash. At max, if you let it run for 1 year, you just get a maximum of 10% of total interest for the entire year, for the entire 12 months, right? But your realized loss could be, say, in this example, 30%. Ask me in the comment section if you still don't get my explanation, but you have to tell me which part that you don't get it so I could clarify it for you. Now, in fact, supposedly, a lot of rich people in Asia lost billions in this kind of instruments back in 2020. And it's not only in Malaysia, so I can put a link below, if you want to read more. Because some relationship manager at banks may make it sound like it is very similar to fixed deposit because it gets you like guaranteed interest every month. But no, it's not a capital protected banking product and is not insured by PIDM. You are actually exposed to the stock market. Now, if you exit early, right, before the maturity date, there's usually a penalty called unwinding cost. And if the underlying stock is actually not listed in Bursa Malaysia, you can be also exposed to foreign currency exchange risk. The thing is, these products are great if the stock price does not change much. But if the market is very bearish, going forward, you could lose as much as if you have invested directly into the stocks anyway. The high guarantee interest rate for these auto callables are there because there's a high risk involved. You don't have the wrong perception. The upside is limited, but the downside could be significant. Many investors think that these products are low risk because of the guaranteed interest, I say, but that is really not the case. If you are considering to invest in stocks, right, you might as well do it directly or look for dividend stocks or even real estate investment trust. Remember, higher returns or higher guarantee returns usually means that there's a higher risk. You might not realize it, right? But that is what the reality is. And this structured investment product, auto callables, really are not suitable for retirees that need a steady cash flow. Right? It's better to diversify investment rather than putting all your money into one stock through all these structures products. And it's my hope that you learn from other people's success and mistakes, so you shorten your learning curve, your learning journey, and avoid silly mistakes, especially disastrous financial setbacks. And do not be fooled into mistaking high risk investment as low risk. At the same time, totally overlook or dismiss any plain vanilla investment, which is actually good and suitable for you.